Welcome to the monthly 3-Edge View from the Edge for March 2024. I'm Fritz Folts, the Chief Investment Strategist here at 3-Edge, and joining me here today is Steve Cucchiaro, CEO and Chief Investment Officer here at 3-Edge Asset Management. This month, Steve is filling in for my usual partner on View from the Edge, Eric Beageleisen, our Director of Research, who is away at an investment conference this week. So today, as we do at the beginning of each month, Steve and I will be providing our firm's most recent outlook for the global capital markets, which is based on our proprietary 3-Edge research model. The month of February was another strong month for global equities. The S&P 500 increased by over 5%, and it was the best February performance for the S&P since 2015. And both the S&P and the NASDAQ reached new all-time highs in the early days of March. In addition, after more than 3 decades, Japanese equities recovered back to highs reached by the Nikkei 225 in 1989. And in an interesting development, both Bitcoin and gold recently reached new highs. However, as the equity markets have continued to rise, there is a good deal of unease among investors about how long this current rally may last and what lies in store for the markets for the remainder of 2024 and beyond. So that enables me to bring Steve into our conversation here and provide our outlook. And we will start, as we do every month, by looking at our 3-Edge asset class matrix and point out what may have changed from the prior month, or in this case, perhaps what hasn't changed. So Steve, take it away.
Well, Fritz, you'll see that the matrix looks essentially the same as it did last month. And it's reflecting the fact that we have both positive and negative forces interacting and affecting the equity markets. However, some of those positive forces are stronger. And so we have increased our allocation overall to equities across our strategies somewhat, but not enough that you'd see a change in the matrix.
All right, great. So let's dig into the major asset classes. We'll begin with the major equity asset class groups, and perhaps you could begin with U.S. equities.
So the model incorporates what we think are all the key cause and effect relationships that affect the various asset classes. And we look at many variables that we've identified as very important. And you can put them in 3 categories. Valuation, which are very long-term in nature. They don't help you much about what the market's going to do tomorrow or the next week or even the next year, but are incredibly insightful as to what the market's going to do over the next 5 to 10 years. Then we have the economic factors that are more intermediate term in nature. And then we have investor behavioral factors, which really drive the markets in the shorter term. The reason why I mention that is in the US, we have such a mix, a dichotomy of results. The valuation factors are showing that the US market is now very highly overvalued, which is a big negative, but not so necessarily so in the short term. The economic factors are somewhat mixed, where we still have an inverted yield curve, which is generally a negative, but we've had massive fiscal stimulus that's more than offsetting that. And then with the behavioral factors, those have been particularly strong and getting stronger as the S&P 500 keeps making new records. Strong enough in the model to more than offset some of the mixed and negative factors elsewhere. So we have increased our exposure to US. However, we want to point out this is not a normal market. This is not a time to buy and hold, put your feet up and say that you can hold these stocks forever, precisely because we are in overvalued territory. The market can continue to rally until a catalyst comes along to really knock the rally down. And until that catalyst comes, we aim to participate in continued upside. However, we are mindful that once a correction starts, it can be very steep given the degree of overvaluation. So we are monitoring very closely all the signs of different catalysts that could end up disrupting the US market.
Great. Okay. So now let's stick with equities, but let's shift our attention to the ex-US equity markets, beginning with European equities. And even though the European economy seems to be struggling, European equities also had a good month last month in February. Is our model picking up anything there?
So two strikes in favor of emerging market equities are, number one, you're right. They're making new records and they're showing positive momentum. Number two, they're more fairly valued than, say, U.S. equities. But on the downside, a lot of the economic factors are showing that the prospects for economic growth are not good. And there are even signs now that certain parts of the Eurozone are going into recession. And that's enough to have us not put any extra allocation to Europe at this time.
All right. Now we'll shift over our attention over to Asia and Japanese equity market, which I mentioned at the top has clawed its way back after 3+ decades. What is the model saying about the Japanese equity market at this point?
Again, there's some mixed signals, but some of the positive signals are getting stronger. Now, we invest in both large cap and small cap Japanese equities. The model is saying that the large cap are fairly valued. Small cap equities are particularly undervalued, which is great for long-term appreciation. As you mentioned, the large cap are now in new record territory, finally surpassing their peak of over 34 years ago. The model is also showing improving corporate profitability in Japan. And furthermore, by investing in Japanese equities unhedged, we have an opportunity to benefit from what we think will be an appreciation of the Japanese yen, their currency. We think it's very undervalued, and the Japanese central bank is poised to end their negative interest rate policy sometime soon. So we think those are all good reasons to have some allocation to Japan.
Excellent. All right. Now we will shift our attention to the emerging markets, and that would include China equities. What is our model research indicating in terms of the direction of the emerging market equities at this point?
It's almost the mirror image of what the model's saying about the US. Here we have highly undervalued equities across the emerging markets. However, emerging markets suffer when the Federal Reserve Board has tight monetary policy. It's a way of attracting capital out of the periphery emerging market countries into the US. And this has helped cause the underperformance of emerging markets, which we think could continue until the point where the Fed reverses its policy and starts easing and we see dollar weakness. That will provide more of a tailwind for emerging markets.
All right, great. So our last equity asset class discussed here today is India. And so what is our model research indicating for the future of the India equity market at this point?
Like the US market, we find it's overvalued, but it's benefiting greatly from positive momentum. And in India, India provides some of the longer term best growth prospects of many, many different equity indices. So it's enough to justify somewhat of an allocation to India as well.
All right, so we'll move on from equities and we'll shift to the bond market and the current interest rate environment, starting with the U.S. Treasury market. What's the model saying about that?
Well, just step back a bit. The bond market rallied in its biggest bull market ever from 1981 to 2000. So the bond market peaked at 2000, meaning interest rates were at their all-time low in the year 2000. And most money managers and investors cut their teeth during that period. So it almost seemed normal that you not only got interest income from bonds, but you get capital appreciation as interest rates steadily came down. Well, those days are over, and it ended when 10-year Treasury yields bottomed out at around 0.5% in the year 2000. And since then, yields have backed up. Bond market investors, especially longer maturity, longer duration bonds, have really suffered since the year 2000. This year, it's a little more stable, still not making money in the major bond indices, but it's stabilized a bit more. And in the short term, we could see somewhat of a rebound because the model shows how the strong dollar is attracting some overseas capital into the US. Having said all that, we're leery of longer term bonds that have duration risk, meaning that if interest rates go back up again, you can lose your principal. Your principal of your value of your bond can depreciate. And we're leery of that risk because we think with all the high debt levels that exist right now and the persistent inflation, bond investors will demand higher interest rates for the privilege of borrowing their money. So those are going to pressure yields higher, not lower. So we favor shorter term treasuries.
All right. And then within the bond market, we'll shift to the corporate bond market or the credit market. What is the model indicating about the outlook for corporate bond market at this point?
Well, right now, corporate credit is very popular with investors. There's a lot of money going into corporate credit. But we look at that, credit spreads are really narrow right now, which means that the bond market is pricing a 0% chance of a recession. And while the economy looks strong enough to avoid a recession, we know that there's more than a 0% chance of recession. We haven't seen yet the full lagged effect of the monetary tightening that's already happened. We know that the economy can be buffeted by a black swan event coming out of nowhere. And so we don't think it's a good risk-reward trade-off. So we're staying away from corporate credit.
All right, super. So let's shift now to real assets, and that would include both gold and commodities. And we'll begin with gold, which I think reached another all-time high recently. But what is the model indicating in terms of the relative attractiveness of gold as an asset class?
Well, gold just recently hit what we call the breakout condition. And when gold or another asset makes a new all-time high and the highest price it's been over the last several years, and considering a buffer above that just to make sure that we're not picking up noise, short-term noise, that often sends a behavioral signal to investors that attracts their attention, attracts capital, and it can be sustained somewhat up until a certain limit we call in the model the breakout limit. And we're in that phase right now. We just entered it very recently. And so something we'll be looking at is the potential to even add more gold to our portfolios. One issue to consider, though, is if there are signs in reports coming up that either economic growth is higher than expected, unemployment is lower than expected, or inflation is higher than expected, these are all reasons for the Fed to delay any rate cuts, and that could stop the gold rally. So we're going to watch that very closely.
Very interesting. Thank you. So lastly, we'll look at another real asset class, which is commodities. I know that the price of oil has ticked up a bit this year, but if you look at a basket of commodities since the equity bull market, since the rally that in equities that started in last October, it's almost like commodities have gone in the opposite direction of stocks. So what is the model saying to us there?
Well, to be honest, Fritz, commodities have been in a bear market for over a decade. And more recently, the model is picking up, again, a negative assessment on commodities. And a lot of commodity demand is, over the years, it came out of China. And with China's economy being so weak, that's been a negative factor, both in the model and the real world for commodity demand. Also, what doesn't always get reported is that the U.S. has been producing oil at a record level. And we're actually, as a country, producing more oil now than Saudi Arabia, which is not a well-known fact. And that's helped tamp the price of the commodity indices, where oil is always a big component. What we see is that right now, we haven't been investing in commodities. That's been a good thing not to. But we think that the time for commodities will be sometime after the next recession, after the Fed and other central banks start to stimulate their economies with monetary stimulus. And that will launch the next commodity supercycle or bull market, because that'll help improve demand. And at the same time, the bear market has helped to reduce supply.
Excellent. All right, Steve, great. Thank you very much. Thank you for stepping in for Eric and providing our three-edge view from the edge for March 2024. That will do it for us. This month's edition, anyway, of the View from the Edge. Eric and I will be back in early April. And if you'd like a hard copy of our full View from the Edge newsletter for this month, you'll find that on our website, which is 3edgeam.com. And meanwhile, Steve and I will be back next week with the next edition of the 3 Edge Week in Review. As a reminder, all of our video content is always available on our 3Edge YouTube channel. If you think someone you know may benefit from our videos, please feel free to share them. So, on behalf of Steve and everyone here at 3Edge, thanks for listening.